Economic conditions are definitely tough right now, with inflation being sky high and the cost of living becoming more and more unaffordable for many people. So this has led to a lot of people believing that we are heading into a recession in the near future, which is likely to impact the earnings of many companies. However, there are certainly some companies that fare a lot better than others during a recession, and sometimes even outright benefit from there being a recession, which could lead to an outperformance in their stock price compared to the broader market. So in today's video, I'm going to be taking a look at 5 stocks that I believe are quite recession-proof, meaning that they can weather the storm that recession brings quite well, especially compared to other companies. So the first stock here today is McDonald's, ticker symbol MCD. So food and drink are core human requirements, and people need to keep buying these products no matter how much their income falls by. So the entire food and drink sector is therefore relatively resistant to an economic recession, especially the more budget brands like McDonald's. So McDonald's is a low quality budget fast food restaurant and is known to have prices that are quite low and affordable for a lot of people. So people who eat at McDonald's are likely to continue to go even if there is a recession, as it's not exactly a major financial outlay to eat there. So McDonald's food may taste nice, but it is still generally classed as an inferior good, meaning that as average income increases, demand will decrease, and this also works both ways as well. So as average income decreases, the demand for inferior goods like McDonald's food is likely to increase. So generally, you can eat out at McDonald's for not much more than it would cost you to buy food from a supermarket to cook yourself. And during a recession, we are likely to see middle-class families replace eating out at a fancy restaurant with going to a budget fast food restaurant, for example, like their local McDonald's, in order to save money. McDonald's is also quite geographically diversified, and almost all countries across the world do have a McDonald's situated in them. So only 38% of McDonald's sales does come from the US, with the rest of their sales coming from a mix of mature, developing and fast-growing international economies. Now, if the US suffers from a particularly bad recession, depending on how much this spills over into other continents and countries, McDonald's will still be generating the majority of their revenue from other countries around the world, which is a good sign to see. So in terms of stock performance through historic recessions, I'm going to be using the 2008 financial crisis recession as well as the 2020 pandemic mini recession as benchmarks to compare the stocks in today's video compared to the performance of the S&P 500. So with McDonald's, they outperformed the S&P 500 in 2008, having a max drawdown of 16% against the S&P 500's 56%. And then in 2020, they matched the S&P 500, and they both had a max drawdown of approximately 32%. Now, McDonald's is also a dividend aristocrat stock that has been paying a dividend for 45 years. So the current dividend yield is about 2.2%, and the average annual growth rate of this dividend has been 7.2% over the last 10 years. McDonald's do have a payout ratio on this dividend of 55%, which means that they can comfortably support paying this dividend with their current income, and there is lots of room as well to grow this dividend in the future. So the reason why we look at payout ratio, especially during a time of recession, is because it does show quite well how much breathing room these companies do have in order to keep paying their dividend. So for example, if the payout ratio is extremely high and nearing 100%, we know that if their income does drop during a recession, then the dividend is likely to be either reduced and cut, or the company will actually be paying out more than they're earning on the dividend. So the second company here today is PepsiCo with the ticker symbol PEP. So Pepsi has an impressive roster of 22 iconic brands and is far more than just a beverage brand that competes with Coca-Cola like some people think. And some of their biggest brands do include Lay's, Doritos, Mountain Dew, Gatorade, Cheetos and Walkers, as well as obviously their classic Pepsi drink as well. So Pepsi do have dominance in many of the markets they operate in, having the largest food and beverage market share in the US, as well as the Canadian market and the UK market, which are 3 of the biggest global food and beverage markets in the world. So 60% of their revenue does come from North America, which is a bit more than 50%, but obviously they do have 40% coming from other international countries as well, and this makes Pepsi quite well diversified across the globe, as they're not just reliant on one country or continent. So in times of economic struggle, people are still likely to find comfort in their favourite snacks and drinks, meaning that Pepsi is quite recession-proof. And then to add to this, Pepsi products are not luxury items, and they're not particularly expensive, meaning that they are not too vulnerable when it comes to consumer preference shifts if their income does start to drop. Now, looking at the stock performance during historic recessions, Pepsi did outperform the S&P 500 in both recession periods, experiencing a max drawdown of 39% in 2008 compared to the S&P 500's 56%, and then a max drawdown of 29% in 2020, which is slightly beating the S&P 500 at 32%, so that's good to see. And then finally, Pepsi is also a dividend king, which means they've been paying a dividend for 50 years now, and the current dividend yield for Pepsi is about 2.8%, with the average annual growth rate of this dividend being 7.7% over the last 10 years. And then the payout ratio for this dividend is 68%, so it means they can comfortably pay the dividend and they're not too close to that 100% mark. So the third stock here today is Walmart, with the ticker symbol WMT. So Walmart is a retail company that operates a chain of supermarkets, discount department stores and grocery stores, and this is across 24 different countries, but it is mainly in the US. And Walmart do offer a wide range of products ranging from food and groceries, technology and also general household items. And then as well as the physical stores that they do have, Walmart do also operate in the e-commerce sector as well, allowing customers to buy products online in a similar way to Amazon. Now, Walmart do pride themselves on leading on price, offering customers the cheapest prices on many items. Now, because Walmart are such a big company and can buy product from wholesalers in a larger quantity compared to other retail outlets, they do often get the best price for these items from the wholesalers, allowing them to offer such low prices to the customers. So in a recession environment where many people have a lower income than before, Walmart is therefore in a prime position to take advantage of many individuals shopping at Walmart more often in order to save money. Now, consumers who used to shop in more high-end stores may choose to switch to shopping at Walmart if they have been hit financially in order to save money. So in terms of stock performance during historic recessions, Walmart significantly outperformed the S&P 500 in both recession periods, experiencing a max drawdown of 18% in 2008 compared to the S&P 500's 56%, and then a max drawdown of just 9% in 2020 compared to the S&P 500 at 32%. Now, Walmart is a dividend aristocrat stock which has been paying a dividend for 48 years now, and the current dividend yield is about 1.8%, and the average annual growth rate of this dividend has been 3.9% over the last 10 years. Now, Walmart do have a payout ratio on this dividend of just 36%, meaning that they can easily cover the cost of this dividend, plus they have a lot of room to grow if they wanted to. So obviously Walmart doesn't pay the biggest dividend, especially compared to the previous two companies, but that payout ratio is a lot lower than the other two. So if they wanted to put more money into the dividends, they could do, but I believe Walmart are focusing more on growth and expanding their business right now. So next up we have Procter & Gamble with the ticker symbol PG. So Procter & Gamble are a consumer goods giant whose range of products span wide across the health, beauty, hygiene, cleaning and also household sectors. So P&G do have a roster of iconic household brands, many of which you probably use or have at least heard of in the past. Many of P&G's products are essential to daily life and consumers use them on a very frequent basis. So through the financial ups and downs in life, most people are still going to buy and use their usual household health and cleaning items. So you're not really going to see people stopping actually sort of cleaning themselves and washing their home, for example, if they have less money. And therefore, because of this, the majority of P&G's products are generally considered to be essential and are quite price inelastic in this sense, making them pretty immune to a recession. So P&G is also quite well diversified geographically, with 47% of their sales coming from North America, with 22% from Europe and 31% from the rest of the world. And this again minimises the hit on their business if it's only the US that experiences a recession, as a good portion of their business does come from the rest of the world. Now, in terms of the stock performance during historic recessions, P&G did outperform the S&P 500 in both recession periods, experiencing a max drawdown of 36% in 2008 compared to 56% of the S&P 500, and a max drawdown of 19% in 2020 compared to 32% of the S&P 500. And Procter & Gamble is also a dividend king, and they have been paying a dividend for 65 years, so that's obviously quite a lot of years under their belt. And the current dividend yield is about 2.6% right now, with the average annual growth rate of this dividend being 5.1% over the past 10 years. And P&G's payout ratio on this dividend is 61%, so they can definitely cover it fine, with a little bit of room to grow as well in the future. And then the fifth company today is Waste Management, with the ticker symbol WM. So Waste Management owns the largest network of recycling facilities, transfer stations, landfills and processing plants in the USA, and they generate revenue through contracts with customers to collect, process and dispose of their waste. Now, the company do have over 22 million customers spread across the government and public sector, as well as residential and commercial and industrial sectors as well. And although the company do operate in only North America, their customer diversification in this area is very strong, as their biggest customer represents just 1% of their annual revenue. So Waste Management's dense network and ownership of key assets allows them to maintain lower costs compared to competitors. For example, they own over 280 landfill sites, which is the same amount as the next two largest competitors combined. It's also incredibly tough for new competitors to start up and compete with Waste Management due to the large moat that they have on the industry and the barriers to entry which do come with entering the space, such as the high startup costs as well as the government regulations as well. So humans are always going to produce waste, and that is on a personal level and also on a business level. So this makes the waste business model fairly immune to economic cycles and recessions. And as a dominant player in the waste removal industry, Waste Management is therefore a very low risk company, in my opinion, in regards to being impacted by a upcoming recession. So in terms of the stock performance during historic recessions, Waste Management did outperform the S&P 500 in both recession periods, experiencing a max drawdown of 33% in 2008 compared to the S&P 500's 56%, and then they did have a max drawdown of 29% in 2020 compared to the S&P 500 at 32%. So that makes all five of these companies that I've looked at today either outperform in the vast majority of cases or match the S&P 500 when it comes to the maximum you're going to see your stock drop compared to the S&P 500. And that's obviously compared to just two recession periods, the 2008 recession, which was definitely a full-on recession, and then the 2020 sort of mini recession, which was quite swiftly recovered due to the money printing that took place, but it's still a good sort of benchmark to look at to see what the stock does in a stock market crash. And then finally, Waste Management does also pay a dividend as well, and they have been paying this dividend for 22 years now, with a current dividend yield of around 1.7%, with the average annual growth rate of this dividend being 5.8% over the last 10 years. And Waste Management's payout ratio for this dividend is 47%, so they can definitely cover it pretty easily, and they do have a little bit of room as well to grow in the future. So that is all for today's video, guys. I did think it would be a good idea to look at some potentially recession-proof stocks, in my opinion. Stocks that sort of fare a little bit better than others if there is a recessionary period, and especially dividend stocks as well, because obviously if there is a recession, then maybe household incomes might drop compared to what they were before, and having some more dividend stocks and some dividend income actually coming in is quite a nice thing to have, at least in my opinion. With that being said, guys, this video is for purely entertainment purposes only. It's not financial advice. I'm not a financial advisor. But if you did enjoy the video, please be sure to leave a like, as that does help out a lot. Drop me a comment, let me know what your favourite pick is from these stocks in today's video. I'd be really interested to see what you guys have to say. Also be sure to subscribe if you want to see more videos similar to this in the future. And apart from that, guys, thanks a lot for watching.